Welcome to the deep dive video update. If you're watching this for the first time, I need to explain the rationale behind this video. Every week I do a lot of videos. I do a video each day. I do a weekly video. I do an intermarket analysis video. And then I go back through all of the charts that I looked at, mainly the daily charts. And I pick out those that I really didn't talk about all that much. And the reason why I call this deep dive is we have to look a little deeper into these charts to see if they're telling us something, because sometimes we can get some clues from this, but they're not necessarily charts that have been used in the daily videos over the past week. There are also some other charts that I have that are unique just to this video, more for informational purposes. This is being prepared for Monday, May 20th. The first chart I show every week in this video, this is the VIX, but you don't see the VIX on here because it's turned invisible. Over top of the VIX is a 50-period exponential moving average. When the VIX was first created, the idea was that when we get to 12 or below to the downside, that means there's no fear in the market, and 20 to the upside, that means there's a lot of fear in the market. Well, the VIX is more dynamic than that as the stock market has changed over the years, and this 50-period exponential moving average helps us to determine the longer-term range of the VIX itself. We went up during the great financial crisis and we're in a higher range. Then as we were coming up out of that, we set a lower range. Then after the COVID plunge, we went into a higher range. And now we're coming down and setting a lower range as stocks have been going up. We don't make decisions based on this chart. There are lots of other VIX studies that I do and related studies that help us to give some insight. This just lets us know in a bigger picture sense, what is the VIX actually doing? Then this is one of the studies, and I did show this earlier in the week. This measures the speed of the VIX by using an RSI based on 9 periods. When this is really coming down, that's usually when stocks are going up. And we did come down to an extreme negative reading a few trading sessions ago. We bounced back up as the market was going sideways and even had a down day. And we're right on the verge of getting extreme again as stocks have been going up. I show it here because as of right now, it's not giving us an extreme reading, but that could change. And when that does change, then I include it in the daily video. Then we look at the VIX, and there's another indicator that we use with the VIX called the VVIX, or the volatility of the VIX. You could say the VIX of the VIX. And then I do a ratio between the two of them. And you can see by looking at the chart up above, typically when ratio is going down, that's positive for stocks. We had been going up for most of 2024, but now we're starting to roll over as we have the Dow, the S&P, the NASDAQ 100. They're setting new all-time highs this past week, and the Dow was able to get above 40,000. And so things are turning a little bit more positive longer term. As long as we see this continue to go down, that is positive. Now, even though we've been going up in 2024, this ratio had been going up, but we're seeing kind of a shift right now in the overall climate of the market as the Fed is making some changes to what's going to happen with interest rates, as the market deals with economic reports. And so there was a lot of apprehension, even as we were going higher, that seems to be coming off right now. Now, this could always turn and go back up if we hit more difficult times. But for right now, this continues to decline, which is kind of confirming the positive environment that we've been in. Then I do another study. I take the VIX and I do a correlation with the S&P. Sometimes when we're not really seeing a lot of clear things with the VIX itself, we can see some things in this study, and I'm focusing on the middle area. When this is getting a very high reading, that can be used kind of like the VIX, meaning that the market is getting very nervous. Well, right now, this ratio is very low. We're not really getting any insight from this, so I haven't been including this chart. And I have some studies. Similar to the VIX is this thing called the MOVE Index. This measures the volatility of bonds, and you can see where bonds have been going up and volatility has been going down. In the middle area is the VIX, and the VIX has been falling and stocks have been going up. What I mainly focus on is the bottom area, the correlation between the two, and it's getting a little bit stronger, meaning now this is not necessarily based on price. This is measuring volatility between stocks and bonds, and it's starting to go back up a little bit as stocks have been going up and bond prices have also been going up. Then this is a related study called the SKEW Index, where the VIX uses at-the-money options to look what do they think volatility is going to be 30 days from now. This uses out of the money options to see what do they think volatility will be 30 days from now. When we get up into this red area, that means a big move is expected. And you can look at other times, I have the arrows on here. It doesn't necessarily mean a top. It can. It can also mean a bottom. Other times it just means a continuation. We're not up into this red area yet, but over the last couple of trading sessions, we have been going up. So we'll be keeping an eye on this chart. Then we look at a ratio between the VIX stocks and volatility and the MOVE index bonds. And this has been coming down, but it has been spiking back up on the daily chart. What I mainly follow is the 50-period moving average. And you can see also here for 2024, this has been trending higher as volatility was picking up in this ratio. Now it's starting to roll over and continue to come down. As long as we stay below this moving average will continue to fall. And that's also kind of confirming more of a positive environment. You can see other times when this ratio was going down, that's typically when stocks were going up. Now, there are always exceptions to that. We were going up in 2024. We were also going up with the S&P. So there's not a real clear relationship between the two. Sometimes they go in opposite directions. But for right now, this is looking a little more positive. Then I usually show this, but it hasn't been doing that much in 2024. This is risk on versus risk off. When folks are risk on, that means they're willing to take on more risk, usually buying stocks. And a lot of times the riskier stocks, the high beta stocks that tend to outperform the market. Then when this ratio is going down, that means they're more risk off. They may be getting out of the high beta stocks and getting more into value type of stocks. And we take a ratio between them. You can see back in 2020 where this ratio was just really shooting up as folks were getting more and more risk on. Well, in 2024, I stopped showing this chart in the daily video because we haven't been really showing any kind of conviction either way. We're coming down a little bit, meaning that we're slightly more risk off. But if we start to go back up, that means that the market is turning more risk on. Then just to keep an idea of where are we in relation to the previous all-time high that was set in early January 2022, as of Friday's close, we're 10.06% above that previous all-time high. We look at a thing called technical alerts. This is put out by stockcharts.com. And this is for the whole week where I go through each day individually in the daily video. When it's green or blue, depending on what color you see, that's positive. When it's red, that tends to be negative. This measures not only the S&P, but the Dow and other major indexes. It also looks at different sectors. And we're seeing an awful lot of blue or green right now as the market has been turning more positive. There's one thing that was actually negative when the dollar dropped below 105. That's actually beneficial to stocks right now. If the dollar's going down, that helps stocks to go higher. The energy sector, which had been strong, is now seeing some weakness recently. And the industrials also had been seeing some strength, pulling back and seeing a little bit of weakness. But you can see right up here near the top, the Dow crosses 40,000. That was the first time ever. And I mentioned this in other videos. When I first started in the markets in the early to mid 90s, they were wondering if the Dow would ever get over 4,000. Now we're dealing with 40,000. Then what stockcharts.com also does, and you can do this with stocks, with sectors. I've never tried it with mutual funds, but you probably can. This tries to remove the emotion of technical analysis. And that's kind of what I try to do. You can have a number of different people looking at the same chart, and every one of them can reach a different conclusion because they're putting their own opinions into what they think the chart is actually saying. And they draw different lines and trend lines and so forth. I try to use indicators and look at things that remove that emotion so I can look at that right now and say, yeah, that's positive, or that's negative, or that's showing strength, or that's showing weakness. Stockcharts.com tries to do the same thing by taking different charts and then giving them a technical score. Now, I do this on the indexes, and there are 5 indexes that I follow. The S&P is the main index, then the benchmark of what I analyze, but I also look at the Dow, I look at the NASDAQ 100, I look at the mid caps and the small caps, and then I rank these to show what is the chart that's the strongest right now. And after not being in first place for a while, the QQQs, which is the NASDAQ 100, they have been showing some improvement, and they're not showing an awful lot of strength, which on one side you could say, well, maybe that's a little bit negative. On the other hand, you can look at this in a positive way and say, well, that means there's just more room to run to the upside. So there's both things that you can take away from that. But it's showing the most strength coming in at 77.8 in the latest reading. And that was even down this past week. Then in second place is the S&P 500. It's represented by the SPY, and it's been holding up better. Now, the QQQs were more weak because they're the growth stocks, and they were really under pressure as we were declining in April, where the S&P was holding up a little bit better. It has those growth stocks in there, but it also has more value stocks as well. But as we've been going back up, the QQQs are showing some improvement, and now the S&P has dropped into second place at 76.5. Then in third place, which for a while in 2024, this was coming in first place. These are the mid caps. Since the end of January, we had been seeing some real strength in the mid caps, and it was one of the stronger areas of the market. And you can see historically, it was really starting to go up. Well, as we've been going back up with the other indexes, this has been showing a little bit of weakness, and it's coming in third place at 73.3. Then the small caps, they're not in last place now. They're actually showing some improvement, coming in at 64.7, but this has been a real disappointing area for a lot of folks. We saw the January effect in December, but then in January, everything just kind of stopped, and we've been really range bound with the small caps ever since then. We're at the high end of the range at this time, but we'll have to see. Are we going to be able to break out of that range, or are we going to go back down into the range that we've been in? Then in last place, even though the Dow just hit 40,000, technically it's not looking all that strong right now, and it's our last place index coming in at 58.9. Then I look at some short-term charts. This is a rainbow, and I usually only show this chart in this video, and I try to take a longer-term look. I go back a number of years with this chart, and then there are different moving averages on this chart going from 10 periods up to 50 periods. And when we were having some trouble back in April, we were coming down into the rainbow and actually dropping below it. And a lot of folks were predicting that we were just going to decline further from there. Well, that's not what ended up happening. And we've been able to come back up out of the rainbow. We're above all of the lines right now, and these lines are starting to turn up as the short-term trend is turning back and looking more positive. Intermediate term, the same idea here. Another rainbow chart going from 50 periods up to 100 periods. It came down into the rainbow, but it wasn't there long enough to really distort these lines, and now we've been shooting back up out of the rainbow. We've been keeping an eye on the 100-period moving average. Not so much now, but if we start to see some weakness, because we fell through the 50-day moving average as we were coming down, and we were wondering, okay, is the 100 going to provide support? And we got really close to it, and then we're able to bounce up off of that. If we start to see some more weakness, I'll be showing this chart to see if this ends up providing support. We have the Connors RSI, which is another momentum oscillator, but it's really spastic on a day in and day out basis. When I really focus on this is when we get an extreme positive or negative reading, and we're not getting that right now, so I haven't been including this chart. Then we have the percent B indicator, and there's a whole book written by John Bollinger talking about how you can implement Bollinger Bands. One of the ways that you can use them is to measure when we go outside of the upper or lower Bollinger Band, and that's what the percent B indicator does. And we just barely ticked outside of the upper band when we shot up in Wednesday's session. And then we came down a little bit, but we were close to that in Thursday's session. But we're coming off of that extreme reading for right now, because if you look back in time, we don't stay above or below either of these Bollinger Bands for very long. And if we shoot to the upside, that means, okay, things are getting a little too fast here, and the market needs to settle down. Now, it can settle down by going sideways or having a slight decline, but we just want to be aware of this. And since this is not giving us an extreme reading, I've stopped showing that chart, even though I did show this earlier on in the week. The point and figure chart, there were some new X's drawn in here, but none after Friday's session. And we're looking more positive here. We were seeing a really solid wall of X's going up, which was actually causing a concern. Then we started to pull back in April. That's where you see the O's or the zeros here. And then as we've been going up and getting above 5,300 for the S&P, we're drawing in some new X's, enough now so that it's actually generating a signal called a double top breakout, and that was generated on May 15th. Then we use a thing called anchored moving averages, and I've been playing around with these a little bit more, but since we're hitting all-time highs, they don't really come into play as much. A regular moving average, let's say it's based on 10 periods. It looks at right now and then goes back 10 periods in history to look at, okay, where is the average right now? Well, an anchored moving average, you put it on a high or a low, and then it extends forward. We had been dealing with this when we were going down last October. We broke through that slightly, but then we're able to come out of that. We're well above this anchored moving average. And I tried it on some of these other highs, but we're still very far away from it. So there's been really no need to show this chart. I also have a couple of other anchored moving averages that go back to the COVID lows that were set, and we're well above those also. And just to keep an eye on how far above or below are we from the 200-day simple moving average. Right now, we're 11.94% above the 200-day moving average. Now, you can look at this chart and go, we're setting all-time highs with the S&P, but we're seeing what could be interpreted as a negative divergence since we're making a lower high. That's not exactly right, because the 200-day moving average is going up. And so that's why we're seeing what could be interpreted as a negative divergence when really it's not. We keep an eye on the S&P 500 on top, and then the S&P 100. And the S&P 100, which does include some of the really big mega cap stocks, it's actually outperforming the S&P, but we're not seeing a real divergence at this point. They're going more hand in hand. So it still shows that as far as the S&P 100 is concerned, the big stocks are still leading the way higher. And we keep a measurement going back to the low that was set in October. And how far have we bounced up off of that? As of Friday's close, we're 22.42% above that low set back in October. A long-term rainbow chart going from 50 periods up to 250 periods. We came back down into the rainbow, but we weren't there long enough to really mess up the lines all that much. And now we're coming back up out of the rainbow, showing that the long-term trend is still looking positive. This is a special K chart, and it seems like we've been positive in 2024, but the weekly chart just will not turn positive. Well, the daily chart here is positive. And the reason I don't show this chart is you don't see many crossovers going above or below this red line. And so I look at it, and we're well above it. So it's just kind of in the background knowing that this is positive. Then we look at a weekly chart of the S&P on top. We also compare that to the German DAX in the middle area. And this is looking at the correlation between the two. And they're having a pretty strong correlated relationship right now. Now, this doesn't mean they're going up or down. This just generally means they're going in the same direction at the same time, whether up or down. And lately, that has been up. We'll take the 10-year yield in the US, we subtract the German 10-year yield, and because US rates are higher, that gives us a positive result. So we're above this red line, which is 0. And then it's kind of interesting. In the middle area, this is the US dollar index. Now, for a while, we've been looking at the correlation between the top chart and the middle chart, and it really wasn't telling us anything. This is starting to get a little bit stronger. So if we keep an eye on this chart, it may give us some clue as to what's happening with the dollar. And the dollar going down does give support to stocks in this type of an environment that we're in. Then the Hindenburg-Omen, we have not had a signal generated here. There's really 3 parts to a Hindenburg-Omen. And what stockcharts.com has done is they've taken those 3 criteria and put them into one indicator. And when we see these spike ups, like we were seeing back in 2019, 2020, right before the COVID crash. Yeah, when this is really spiking up, that's a real warning sign to us. And you can see what happened. Sometimes it was kind of a big move, and then we had the whole COVID plunge. And then we had one right at the end of 2021, and that led into 2022. Well, we did have one that was triggered back in February. But what needs to happen for this to be valid is there has to be 2 spike signals within 20 trading days. And now that we're in the middle of May, this was not confirmed. We're not seeing any new spikes. So there's been no need to show this chart. We look at different areas of support and resistance. These are possible fib retracement levels. I readjusted this. It had been going back to the previous all-time high that was set in March. Now it's going to the new all-time high that was set this past week. If we start to see some weakness, we'll be watching these different fib retracement levels, but we're far away from them. And of course, if we do keep going up with the S&P, this chart will need to be readjusted. Then this is an indicator that I developed a long time ago. It's really just a 20-period simple moving average of the open, high, low, close. This produces its own little mini rainbow. And when we're going up and we pull back, one of these lines will often provide support. When we're going down and then we start to bounce back up, one of these lines may provide resistance. We were finally able to break above this mini rainbow, get above it, and now we're seeing the mini rainbow itself actually start to turn higher as stocks have been improving. And since we're not really near these lines right now, I haven't been showing this chart. And we look at the Vixen, which we have the VIX that measures the volatility for the S&P. The Vixen looks at the volatility for the NASDAQ 100. And as it's been going up lately, we are seeing this drop off. The bank ETF, the financial sector's hanging in there pretty well and holding up. There's been a year ago, there was Silicon Valley Bank and Republic Bank, and then a few months ago was New York Community Bank. There are worries in the whole financial sector if interest rates don't fall, because a lot of these smaller banks, they are preparing for the Fed to cut rates. They're going to have to refinance some things, and if they can't refinance them at lower interest rates, that could really cause some problems. So we just want to keep an eye on this, but this is holding up for right now and actually in a pretty solid uptrend. Similar to that is we do have a regional banking ETF. These would be the smaller banks, and we compare it with the financial sector. It's still underperforming. Now, when we really drop down, this is when Silicon Valley Bank came out and Republic Bank, and then we chopped negative for quite a while. We were starting to look better, and then the New York Community Bank news came out, and that's when we dropped down here. We are still underperforming and in a downtrend with this ratio. If we see more bad news coming into the market, we'll want to see what this ratio ends up doing. Then we have the S&P on top, and then a ratio between the Qs and the diamonds. That's the NASDAQ 100 to the Dow. And I look at the correlation between the two. As the Dow has been lagging a little bit, even though it got over 40,000, it's not showing an awful lot of strength right now. But we're seeing this correlation actually dropping off as the Qs have been outperforming. And we keep an eye on the transports. This has been one of the more disappointing areas of the market. The black line is the Dow, the red line are the transports, and they are really underperforming. And it would be more positive if we could see the transports kick into gear. There are three main areas: the Dow, the transports, and the utilities. The utilities are just screaming right now, and the Dow's over 40,000, setting all-time highs. But the transports are really lagging behind. It would be more positive, and you can see other times when we were going up, the red line was above the black line, even though they're on different scales. We look at another ratio between large caps, which is the Russell 1000. That's kind of like the S&P 500. And then we have the Russell 2000, which are small caps. And for most of 2024, we've been inching our way higher, but we're not seeing any real convicted moves here. So I stopped showing that chart for the time being. Then some rate of change charts. These are just for information. I don't show these in the daily video. This goes back 250 periods and showing that we're still looking good there. Then going back to 1980, we are looking positive. We're coming possibly back up to this line. Now, I put this line on here. It's just kind of a reference point. But sometimes when we get to this level, I guess that's 30 for that reading. When we get above this, sometimes that means even in the long term, we might be getting overextended to the upside, but we can go well above that level also. Keeping an eye on bonds, and I've been showing a lot of stock to bond ratios recently. This one I haven't been showing. I've been showing another chart called tips to the 7 to 10 years, and that's been more pronounced. That's been moving faster. This one's been moving slower. When the market is really concerned about inflation and interest rates, they get into tips. These are shorter term. They adjust for interest rates. They allow for a more inflationary environment. And so folks want to get into those. And we see that outperforming the 3 to 7 year bonds, where you're locked into a yield for 3 to 7 years. Then when this is coming down, this means that inflation worries were starting to subside. Well, now we're starting to go back up, and we're actually seeing a golden cross with this ratio. I've been showing other charts saying that, yeah, this is still a concern to us right now, And this isn't really moving all that much on this chart. The other charts are moving a little bit more. We want to see this ratio start to come back down if we're going to turn more positive as far as inflation and interest rates are concerned. Then we have the TLT, which is the long-term bond ETF. That's in blue, and the S&P on top. And we look at their longer-term correlation, which is getting a little bit stronger. And we look at a shorter-term correlation, meaning that they're having a tendency to move in the same direction at the same time. I have a couple of different studies down here on the bottom, just the spread between the two shown in a couple of different ways. I don't focus on that too much. And we have the QQQs on top, which are in black. And then that same TLT, the long-term bond ETF, and we see that their correlation had been stronger. It actually was going in the opposite direction for a while. Now it's showing that they're having a tendency to go more in the same direction. And that would be the environment that we're trying to get into, where we see stocks going up and bonds going up, because when bonds are going up, that means interest rates are going down. And we want to keep an eye on the yield curves. We're still inverted with the 10 to the 2 and the 10 to the 3 month. When these go back above this red line and actually go back to being normal or uninvert or just become regular again, a lot of times that begins a countdown to see if we're actually going to go into a recession. We've been inverted now for a couple of years, especially with the 10 to the 2. The 10 to the 3 month took a little bit longer to get inverted, but this is just something that we watch, but it's gone on for so long now that we can watch it on a longer term basis. And then I have a number of things called a number of things called the possible positive scenarios. And these are usually helpful when we're really going down and we maybe gone down too far too fast, and we can use a number of different charts to see, is this potentially a bottom that we can bounce up from? This was really helpful back in 2022 when we were chopping up and down all over the place. Well, there's still some charts that are helpful, and I show those in the daily videos. There's some additional charts that I include here. This first one is a study that looks at the percent of S&P 500 stocks above their 200-day simple moving average. Now, there's a kind of a variation of this that I do show every day. This particular chart I use like an oscillator when we look for an extreme positive or negative reading. When we're above 50 and going up, that means we're more positive. If we're below 50 and declining, then we tend to be more negative. So this chart is looking positive, but not really giving us any additional insight currently. We get enough from the other study based on 200 days that I look at. Then we use that same concept looking at the S&P and their stocks above their 50-day moving average. And this is going up. We can use this like an oscillator, but since we're not getting an extreme positive or negative reading, I haven't been showing this chart. We look at the mid caps, which are showing some improvement as well. And then we also look at the small caps. And then we look at the S&P on top and then the 2-year treasury yield. Sometimes when this really goes up, spikes and starts to come down, that can give short to intermediate term support to the S&P. Well, this is continuing to go up for right now, so it hasn't spiked and started to come down, so I haven't shown this chart. Thank you. I really hope you found this helpful. I hope you have a really good weekend, and I will talk to you in the next video, which will be the what to watch video for the upcoming week. So have a great weekend, and we'll talk to you in that video.